So, hey, how's it going, Crypto University? Happy to see you again. This is Warren, and we're always trying to bring you just the best and brightest in the industry whenever we do a interview of such. And so, right now it's been tax time, and some states it's gotten extended, and so we wanted to reach out to some of the professionals in the space and just try to answer some of the questions that I know are on each and every one of you guys' minds that you guys are always hitting me up in the PM and asking. So what we've done today is we've brought in Clinton Donnelly, and he is from the cryptotaxaudit.com is his website. And so you can check him out there. But he is a professional in this space. He deals with many people who would be considered large whales in the crypto space, and has done tax returns and stuff for literally thousands of people just like you and I. He not only specializes in, U.S. taxes, but I mean, he helps people that, were originally in the U.S. that have chosen to live all around the world and, ultimately help sort out their tax liability. So, Clinton, I just want to welcome you to the call today and tell you thank you so much for your time. How are things in Portugal?
Things are great.
Great. So, I know, like I said, our guys are, definitely interested in this topic, and obviously, everybody's trying to do the right thing here. So, why don't you just maybe kind of start just at a high level? Obviously, just tell us a little bit about what you do, how long you've been doing it, and then, yeah, there you go. How's it going?
There you go. I got the camera on.
There we go. So, just tell us, a little bit about what your practice does, how long you've been doing it, and then, we can kind of go from there.
Well, certainly, I have an advanced law degree in international financial regulation, which includes taxation. And I'm also an enrolled agent with the IRS. I can represent taxpayers worldwide before the IRS, which is what I do. I actually, at this point, I have clients in 62 different countries. And from Japan, actually surprisingly, many of them in Tokyo, Australia, Russia, China, India. So as well as the West Coast and Texas. So,
awesome.
So actually, I think you were asking what we do. One of the things we do is my entire company, about 14 employees, and we're still hiring. We all work remote. And when you work remote, you can work just about anywhere you want. So right now I'm talking to you. The sun is starting to set on the southern coast of Portugal as I look out on the Atlantic. So I didn't want to make you too jealous, but it just happens to be where I'm spending this week.
Yeah.
We got into crypto trading back at the beginning of 2018. And I was working with a team that was, I spoke to hundreds of people who were crypto traders who wanted to get tax returns prepared. And I eventually, I left there where I was the legal representative, and I started bringing crypto traders onto my own tax practice. And it's just mushroomed since that point in time. I've written 4 books on crypto taxes. And now we've created the whole crypto tax audit website, which is designed to help the everyday investor to protect themselves from the IRS, to understand the whole U.S. taxation scheme, and to have tools to prepare a high quality, what we call a bulletproof tax return. So that's what we do now. Our firm does the entire work. We do the gain calculation, both for regular crypto and DeFi, which has unique complexities. And then we do the return preparation. And with Crypto Tax Audit, which is a monthly service where we actually defend people in audits by the IRS of their cryptocurrency. So I have 19 people I'm representing in audits before the IRS on their cryptos alone. So that gives me a unique perspective in terms of what the IRS is doing. And that informs our entire process about how we prepare tax returns. And so I hope, in our talk today, I can give people the benefit of the wisdom and the experience that I've accomplished.
Awesome. Yeah. Well, I mean, so let's just start here. I mean, obviously, some people know what is kind of the requirement or what the expectation is from the government right now. I know that over the last several years, it's kind of grown, changed. Like sometimes we say, hey, look, it's, only capital gains that we owe. And then all of a sudden it was like, hey, like every single time you do a trade, you owe something, or, every time you flip a coin from stable coin to a cryptocurrency, there's another taxable event. So maybe we'll just start with like, what are you seeing in the landscape now as like an actual taxable event or a place where people would have a liability?
Well, the IRS came out with a document in 2014, and they basically defined something called virtual currencies, and cryptocurrencies are a part of those. And they said that they are considered property for tax purposes. So property, you make money off property when you sell it. For example, I buy a used car, I give it a paint job, and I sell it, and I make $1,000. Well, that $1,000 gain is what is considered a taxable event. So let's break that down a little bit in terms of the tax law says that whenever I sell or exchange property, I experience a gain or a loss, which must be reported on my tax return. So, and as a very interesting question came across Twitter yesterday, the guy said, hey, if I sell my Bitcoin and I trade it for another coin, or I trade it for USDC, and then later I take out the cash, do I only owe taxes when I take out the cash? And that was kind of interesting because they basically crushed a lot of events together, and it confused them. So when he sold the Bitcoin, at that time, that was the taxable event. It was not the buying of the other coin, it was the selling of the Bitcoin itself. That's what caused tax, or a taxable event, a gain or loss, whatever type. Having moved it to, say, another coin, well, that's fine. At some point in time, he sells that other coin for, and he's in this example, cash, fiat. Well, that's another taxable event, right? And it might be a gain or loss as well. So every time the tax law says sell or exchange, today we might want to say sell, exchange, or swap, given the vocabulary of the day. But anytime you give up a property, that's when you have gain or loss that must be reported for taxes.
Okay. Yeah, that totally makes sense. I mean, I know that, a lot of guys have been asking the exact same question. They're like, hey, if I bought Bitcoin at, say, 10,000 and it's gone up to 15,000, but then I switch it over to a stable coin and then I go in and, buy, say, Ethereum at that point, did I create a taxable event at that point, or am I just still rolling over what my original investment was? So I think you cleared that up. There's definitely a taxable event that's in there. So what, here in the US, what are they actually looking for in that taxable event? What are you seeing as far as the liability there, as far as a percentage or portion that they're trying to get from that?
Well, the way what you have to do when you're doing taxes in the US, you have to generate a form. It's called 8949, and it lists every single event, every single property that you sold, every single crypto you sold, and you state, here's when I bought it, here's when I sold it, here's what I bought it for, here's what I sold it for, and here's how much the gain or loss was. So you list it all in that one form, and then you add it up, and the gain column basically, it's going to be either a net gain or a net loss. If you take that net gain or loss, it hits your Schedule D, which is where those things are reported, then goes onto your tax return. And if it's a loss, it reduces your taxable income by that amount, or if it's a gain, it increases it. So that's roughly how capital gain fits in. Now, typically, the tax rate on capital gain, there's two tax rates. One is typically, if it's called the short-term capital gains rate, and that's what your ordinary income tax rate is. So when we say ordinary income, we're talking about the progressive tax bracket that you're being taxed at, like 22%, 24, 32, 35, whatever. This is your tax bracket. That's the percentage every new dollar will get taxed at. And so short-term capital gain, the net capital gains, are taxed at that amount. If you hold an asset longer than a year, then it gets a better, more favorable tax bracket, which is called long-term capital gains, which for most people is going to be 15%. For the people in the highest tax brackets, if you're over roughly, 450,000 or more, it's going to be in the 20% bracket. And if Joe Biden gets his way, he wants to create another tax bracket of 39.6. So,
wow.
Stay tuned. What the lawmakers want to do. So,
right. Yeah, I remember. I know that definitely scared a lot of people that day. I mean, it wasn't the best day in crypto when they launched that that new campaign of wanting to have higher taxes. So it definitely scared some people for sure. Like, oh my God, more seriously. But so that's cool. All right. Well, so basically, I guess your recommendation there would be, I mean, we obviously have a bunch of different people that are investing in the space. Some that are short term, some that are long term. So for say those people who are looking at this as maybe like a 4-year or longer investment, you would say, make your initial purchase as maybe being like the best way to not create a bunch of taxable events would be, create your initial purchase into whatever coin it is that you choose. And then if you're holding that, say for 4 years or maybe 10 years, at that point, then if you were to cash it out at that point, your liability would be less with that longer term capital gains kind of percentage rate kicking in at that point. Was that accurate?
Oh yeah, I mean, there's different trading methods. If you're a true long-term hodler, there's no tax on buying the crypto, no tax at all. Oh, and let's say even in a situation where, like, say I have to go onto Coinbase and I have to buy Bitcoin, and then I have to move that Bitcoin to some other exchange in order to buy my favorite coin. Typically, if you're moving it that quick, there's very little up or down gain, so not much tax to be worried about there. And then you buy that coin you love and you sit on it for a couple of years. There's no tax on holding it. Yep. So that is a good piece of news. There's no tax on holding. I think that a lot of people get confused on that.
Yeah, totally. Yeah, glad you're able to clear that up. I'm sure that probably helps somebody for sure. Well, I mean, obviously there's a lot of different ways too, and I'll just kind of, keep pushing this ball up the hill here. So, outside of trading and outside of buying and hodling, some of the other new kind of more popular ways of getting into crypto are, say, like DeFi. How do the taxable events kind of trigger or work in the world of DeFi, just at a high level? How is it different in that environment?
Let me back you up a little bit. Let's talk about a couple other tax methods. DeFi brings a lot of these together.
Okay.
So let's talk about mining. Okay. Yep. And I realize that we're now in a world where everybody's staking instead of mining. Let's talk mining. Okay. In mining, you're buying hardware. You're paying for electricity to run it, maybe some space in your house or some third-party location. And then hopefully it generates coins.
Right.
And so we would treat that as a small business or a home business. You report this on Schedule C, which is where you report businesses. On Schedule C, you list, how much is your income and what were your expenses. So for a miner, we don't know how much he gets taxed until we look at what his expenses are. All right, so he mines a bunch of coins. And let's say when he mines a coin, it is treated as income, ordinary income, at the fair market value in US dollars on the day he receives it. So whatever the value is of that coin that day, that's the income amount. That amount also now becomes what we call the cost basis for that coin. When he, now having held onto it, it's becoming an investment. Okay, so he holds onto it in the future. If it increases from that initial amount, then that's the gain. So for mining, we have the income and then we have expenses. The tax laws being what they are right now, typically as you buy a miner, the hardware to mine, you can almost write that all off in the first year, which is great. And then the cost of electricity. Now you can only write off the cost of electricity to run the mining equipment. You can't do your entire house. Okay, so you got
my whole house mines though. I was just like,
IRS has seen it before. The cost of the internet service for that, if used, and then typically a little bit of home office space could be dedicated to it. Typically, in your first year, the year you buy your miners, you're not going to make, on paper, you're not going to make much profit because you're recovering your expenses. And that profit or loss goes straight to your 1040 as net income or expense, treated taxed as ordinary income at your tax brackets. Okay. Yep. So that's mining. Now let's talk staking. So staking, I have a set of coins or tokens that I'm putting on deposit somewhere, and I'm locking them up. And as a reward, I get, we call them rewards, right? But they're basically, from a tax perspective, they're like interest. It's something I'm getting because I have something on deposit. Technically, interest only comes from banks, but it's effectively the same thing. It's taxed at your ordinary income tax bracket. So that's how rewards are handled. Sometimes rewards come in the same coin, or sometimes they come in a different coin. It doesn't matter. The fair market value on in US dollars on the day you receive it is considered the income amount for that coin. Okay. Another source of income would be airdrops. And airdrops are treated as taxable income in the fair market value in US dollars on the day you receive it. And the only exception I would see in that definition would be the very, very, very first day a coin exists. There's never been anyone who's ever traded it, so there's not really a fair market value according to the U.S. IRS definitions, which we don't need, which is what a knowledgeable buyer and a knowledgeable seller would agree to as the price, neither being under compulsion to buy or sell. So if there's never been a sale, nobody could say what the price is. So particularly the big interest topic today is, hey, I'm getting Spark tokens, a 15% drop on the first month. What's it going to be?
Right.
Well, in my opinion, my professional opinion, since there's never been a trade, I would treat those on the first day as having zero cost. So the cost basis is zero. There wouldn't be any tax on it until you sell them. When you sell them, it's going to be pure profit, pure gain at that time. Now, the second month, because that's going to be every month you have Spark token drops for many months. The second month, of course, people have been buying and selling at that point. So now those subsequent airdrops of those Spark tokens are going to be taxable as income in the fair market value on the day you receive them. So there would be tax on those subsequent ones, in my opinion.
Okay.
So that's airdrops. I think we covered most of the standard other things. Is that before we get into DeFi, did I cover it all for you?
Yeah. No, that's definitely, I mean, those are most of the ones that we would see, like, airdrops, mining. I think you covered all of those. But yeah, DeFi, I think is another question. And then I've got probably two more that just came up in what you just said. So yeah, how does DeFi kind of roll all that together and how you see that?
So this is DeFi presents a certain set of challenges. We divide DeFi into two types. Okay. One that involves smart contracts and one that doesn't. So one that wouldn't involve smart contracts is where you're just doing a simple swap, this coin for that coin. And that's just like it is on an exchange. There's nothing different about that. One of when we get into smart contracts, now we're talking liquidity pools, rebalancing tokens or rebasing tokens, yield farming, and a host of other sophisticated, complex type of instruments, including lending protocols as well. Okay. And all of this is made much more complicated by the fact that with DeFi, because it's decentralized, there's not a recording of the transactions. Mm-hmm. All right. So if you're on Coinbase or Kraken or Bittrex, I can pull down with an API key, I can pull down the entire transaction history later to do my taxes. And the benefit of that is it tells me, okay, gave up this coin to get that coin, and it's all well documented. But when I go to DeFi, the attitude is everything's on the blockchain. Unfortunately, the blockchain is not really well instrumented for tax purposes, and it creates a situation where we cannot completely determine what happened without some human input onto what the trading was. The second so that's one problem with DeFi, is that we have very poor records. Sure. And part of that is, like, for example, a contract may not use the same contract number when it posts a reward to your blockchain. It may use a different contract. And when we go back to analyze it, we can't really connect the two because it's using a pooled wallet to pay from rather than the dedicated wallet. There's a whole slew of things that go on that are complicated about use of the blockchain. Okay. The second challenge with DeFi is a tax code related problem. The tax code in the US is biased towards recognized gain. That is to say, you're taxed when the money, becomes yours. So, when you get a paycheck, that's when you're taxed. When I sell a coin, even if I trade it to another coin, that's a personal choice. But when I sell it, I've realized some sort of gain and I get taxed on that. But with DeFi, or with I shouldn't say DeFi, but with complex DeFi is what we call it. It's not always clear when that happens. I might have a yield farm where the quantity, I might have ETH versus, paired with DAI. And when the value of ETH goes up, my quantity of ETH goes down, the DAI goes up. And this is happening all day long. And it may be posted to my blockchain. It might not. It may be some other things happening. And then I'm getting rewards posted to me. And it might be in one of those coins. It might be in a third coin. And, so a lot of things going on there. And typically we don't really know if we've made money with a liquidity pool. Let's back it up this way. With a yield farm until I've actually closed the position. Right. And then I know if I had a real gain, because I might just be having a change in quantity of coins, but not necessarily an increase in wealth. And if you don't know about yield farming, this probably just confused you. Now, so let's talk about liquidity pools. I think this is a very important area where people need to be aware of how taxes are handled. So with liquidity pooling, I'm taking some coins that I have, let's say I have ETH, and I put it into liquidity pool. And I am leaving it there for months and I get a receipt, in a sense, from the smart contract that's holding my coins. And that receipt is basically, we call that a liquidity pool token. And I can trade it back in to get my original coins back. Uniswap has a Uni token, a Uni 2 token, and in the future, a Uni 3 token. So that's kind of that type of thing. So have I actually sold my coins that I've put into liquidity pool token when they've given me this? I put some ETH into a liquidity pool and I get a liquidity pool token back. Like, let's call it a Uni 2 token, right? Right. Is that a sale? I mean, no, not really, because I expect to get my tokens back.
Sure.
I call this a receipt, right?
Yeah.
If I go to a show and I give the coat check girl my coat, she gives me a little, chit of some sort, and I bring it back later. I get my coat back, right? I don't get somebody else's coat. I get my coat, right? So, no, I haven't had a sale, but the problem is a lot of the crypto capital gain software that's out there, and there's about a dozen software products out there. It's not worth naming them, but they wrestle with this problem. This is a wrestling, and a lot of them have taken the approach of saying, well, that's a taxable event. We're going to say those coins got traded in for this liquidity pool token, and we're going to recognize a gain event there, or maybe we won't treat it as a gain event, but we're going to treat it as a trade. And then whatever you do, and then you come back and you're trading it back to get your original tokens. And what we feel is there's a couple of things that are happening here. We're creating false capital gains events that aren't really happening, because I never really sold these tokens. Remember, they're still mine. And the second thing is the way they're treating this, they're chopping up your into a lot of small capital gains events. So one of the benefits of liquidity pooling is that I can leave it there for a long term while I should be able to get long-term capital gain status for it at some point. But if the tax software, your crypto gain software you're using is chopping it up, you won't get that. You won't experience that. So you need to be aware of that when you trust these services. There are some real gray issues. Let me just be frank. Everybody's struggling with it. All right.
Yeah.
If you dabble in, let's call it complex DeFi, you're entering into a complex tax situation. Now, part of the problem here is some of these investments, like the liquidity pools and yield farming, fall into what traditional finance calls derivatives. And derivatives create gain without actually having realized it. Yield farms will talk about impermanent losses and that sort of thing. So a derivative, it just constantly changes value. So the problem, the tax code doesn't know what to do with that. They have had derivatives for many years, and the law Congress has put some laws in place to tax these. However, they've restricted it to only transactions happening on recognized exchanges, like the NASDAQ, commodities, Chicago Commodities Board, these places. Well, that leaves, Uniswap, in limbo. So we do have a certain amount of gray area here in terms of taxes. Our company, we do a more custom job. We take a more personal view. We treat the entire blockchain address as a complex financial instrument that you as the investor are choosing with a modular approach the things that you're going to do in this complex financial instrument. And then we generate a tax report summarizing the net results from this financial instrument. So that's what we do. It's a little bit different. It's a little more expensive, but I think it also is more accurate in telling the story of what you did investing wise in DeFi. So it's a big challenges. And as we grow in DeFi this year, more DeFi investing is taking off. I just need to let everybody know, if you really get excited about DeFi investing, especially with the complex type, you have a larger tax bill for calculation. It's not the taxes themselves, but for the cost of calculating your return.
Totally. Yeah. I mean, DeFi came onto the scene, and I know a lot of people are participating in that for sure. I mean, I assumed it would be very complex because it's very hard to track. And I mean, even for like your everyday, trader, who's maybe making, multiple trades. I mean, we see so many new people that come in who end up, selling the big red candles and then buying the big green ones on a day-to-day basis. So, I mean, what would be some of your recommendations just on like how to like keep track of some of this stuff as you're doing it? And like, what are maybe some of the more important things to try to keep track of? I mean, just to be responsible, I guess, with what you're trying to report.
Well, record keeping is the Achilles heel of the crypto industry.
Okay.
Exchanges have API keys that you might use to plug into some crypto gain software to track your portfolio value. There is no exchange that's committed to 100% accuracy on those. So there are some really big name exchanges that have gone and just lost the records for a couple of days. So if this were Fidelity Investors or Merrill Lynch, something like that, investors would not tolerate this.
Sure.
But this is what you get with crypto trading. This is why the fees are so low. That would be one issue. And I will say this. So when you do your taxes, you pull your API keys and CSV files from the exchanges, and that gets you a long ways to preparing your tax return. Okay. But I'm going to tell you the number one thing is defend yourself in an audit.
Yep.
And this should be a practice that everybody should do. And this is really low tech.
Okay.
So it involves this.
Old trusty notepad.
Notebook and one of these high-tech devices. Okay.
Yep.
And I'm dead serious. The courts put significant value on what's called a contemporaneous log.
Okay.
Anybody who is an outside salesman and drives from place to place has to keep a log of what his mileage was at each stop. And you have to keep it real time, and they stick it to their dashboard and they write it as they go. And the courts say that if you do it that way, they will take your word for it that it's correct because it's contemporaneous. And what makes it contemporaneous is that the handwriting varies. The ink changes because you use a different pen. Your handwriting is sloppier one day than another. These are all the aspects of real. Okay. If you say to yourself, I don't need to use that, I'm going to use a spreadsheet and type it all in. So, that doesn't, you could make that up the night before you give it to the auditor. It doesn't have the feel of credibility. What do you do with this? The first thing you do is you write down all the wallet addresses that you have. The second thing you want to do is write an inventory of all the coins you have on that particular date. Everything is date stamped. Okay. How many coins do I have? And you write them all from all your exchanges, write them all day. Say at that date, this is what I had. And now going forward, as I make each trade, just write down, May 25th, I traded, I sold, 4 Ethereum for $10,000. All right. And on Kraken, that's all you need to write. Okay. Don't need to know about the fees. You don't have to be exact to the 100th decimal point. Just write down what happened, because the reason this is helpful is when we do your taxes, especially if it's DeFi, we have no idea what you invested in. Was that a 70-30 DeFi yield farm, or was that a 50-50 yield farm? We don't know. You can't pick it up from the blockchain. Only your handwritten notes would tell us that. And if you handwritten notes, you said, I closed that particular DeFi position on such and such a date, then that is real. I mean, so why is that important? Because in an audit, the blockchain is not your friend.
Okay.
The blockchain clearly states coins went in, coins went out. And the auditor loves that. He goes, coins went in. That must have been income. I'm going to tax all that. And you're saying, no, that's not income. It was coming from this smart contract I had over here, which I had invested some coins over here to make that happen. The blockchain doesn't really tell that story, not in a manner in which a simple auditor is going to understand. Okay. So the blockchain is not your friend. Your notepad is going to be compelling, absolutely compelling. I mean, so when I talk to auditors and we say, well, I want to see all your Coinbase transactions, so we export a CSV file from Coinbase, well, the trade history, we give it to them. They go, no. We want to see the PDF file. Well, that thing is like 5 times longer and it may not have all the same columns. And it doesn't say nice headers like this is Coinbase. I mean, it's really just a formatted looking spreadsheet in PDF fashion. And still not the same thing as a statement that would say Fidelity Investors, Covington, Kentucky. It doesn't look like that. All right. So that informality all works against you. So, those are a couple of my advices. That's a gem. That one's for free.
Sure. No, that's good advice. I appreciate that. Well, at the same time, I mean, let me just ask you this question because I'm sure it's on everybody's mind. I mean, like, is it a bit of a challenge for, the IRS and others to use the blockchain to like track and get all of this information, or is it readily available for them and very easy for them to pull up all of this information?
They're struggling with it. The part of the problem is that the tax code allows you to pick after the fact, after you've done the trade, what it was that you sold. Was it the coin that you bought a year ago for $1,000? Is the coin you bought 2 months ago for $3,000? You can decide that after the fact, months later. So by the tax law letting us do that, it doesn't change the fact that when I sold that coin, it actually was one of these coins. Okay. Right. And so in the tax law, when I report what my sales were, they don't necessarily map exactly to how the blockchain went down. So for the IRS, pulling the blockchain doesn't necessarily lead them to correct answers. So it doesn't help them in terms of calculating gain. Right. It does help them in terms of saying, hey, here's some coins, explain this. But they have just recently negotiated a contract with a company called Taxable, which was one of the top dozen companies doing crypto gains calculations. So Taxable is now going to be doing gain calculation for the IRS on you and me. So I suppose they'll have to, an auditor will have to say, look, I'd like to get this guy evaluated. There'll be an investment cost and internal negotiations. Sure. And then TaxBit's going to do the calculation. Now, TaxBit does not do DeFi, and I think they don't do margin very well. There's a lot of elementary things. TaxBit was never your top provider, which is probably to your advantage if you get audited, because they're not going to be able to do as good a job. That's why in an audit we just talk our circles around the weaknesses of TaxBit compared to what we're doing. Sure. So it's a challenge. I mean, you just don't want to be audited. That's the bottom line.
Well, let me ask you that now that we're on that topic. I mean, where does that typically kind of like start? I mean, where do you see, is it the magic where you go in there and check the little checkbox that you bought crypto that signals the audit, or, what are you seeing that kind of, would start that from their side when they're looking into all of this?
Great question. First of all, everybody should check yes on the virtual currency question.
Okay.
Our studies show that about 70% of Americans should check yes. Virtual currency is not just cryptocurrency. It also means frequent flyer miles, where I can use to trade in, to buy airplane flights, or credit card points on your credit card. I use some of my credit card points that I actually pay down my bill with the cash. Going to the grocery store, you accumulate points that you can buy, a pan to give your wife at Christmas time. All of these are forms of virtual currency. Okay. And a lot of people are afraid to check that box. They think that's going to result in an audit. No, it won't. It's basically it's a perjury trap. So the idea if somebody checks no, and then later they find out, yes, you had some virtual currencies, you didn't report it, but you checked no in this question, they can now say you gave a fraudulent answer. Now, something really happens to the IRS. The exciting thing that happens when they can say your tax return was fraudulent is that you lose the statute of limitations protection. Statute of limitations in general is after you file a return, the IRS has 3 years to audit you. If you're inaccurate on your tax return by over 25% of your income, let's say you failed to report, 25% of your income, then they actually have 6 years to audit you. But if the tax return is fraudulent, you lose all protections. Okay. Yeah. So the safe answer for everybody is yes. Yes on that question. The second area of exposure for an audit is failing to report your cryptos in a year when you might have received a 1099K from one of the crypto exchanges. We knew Coinbase was doing this, Uphold, Robinhood, I think Gemini were all issuing 1099Ks, which lets the IRS know that you did a lot of transactions. Now, these forms, the way they calculate it, they're only adding up the proceeds column and never reflecting the cost. All right, so they can get some really, especially if you're a frequent trader, these numbers can get enormous.
Yeah.
So if you have one of those, by golly, you better be reporting your cryptocurrencies that year, because that's like a dead giveaway. You're guaranteed. The IRS sees this. After you file your tax return, they have a program which goes and looks at all your 1099s and W-2s, K-1s, add them up, say, this guy should report at least this amount of income. And if you don't have that on your tax return, like that's an instant audit. You can just bank on it. Come November, they'll start to send out letters on this. So that's the second big one. The biggest risk right now, the second risk would be, the second risk would be if you amend a tax return. We're seeing amended tax returns, which are usually mailed in paper format, are having a 5 times higher audit rate than the initial filed return when they both have cryptocurrencies. That's not good. All right. So what a lot of our clients are choosing to do is they're saying, hey, let's file this year's tax return absolutely correct. Just do it correctly, do it right, and make this the first year I do it correctly, and do it going forward. But for the previous years, they're choosing to use our crypto tax audit membership subscription. And it's a monthly membership, $35 a month, where this is a cheap ad here. I cleared it with you.
Go for it.
What I'm going to describe to you, nobody else in the United States is offering. So for $35 a month, we monitor your IRS accounts on a weekly basis, and we can see when the IRS supercomputers have flagged one of your tax returns for an audit. They actually put a code on it. Okay. We let you know about that right away. Then typically it's about 6 months before an auditor actually initiates an audit. And that gives us time to look at your return, fix anything lacking, and refile it before the audit begins, and thereby avoid the 20 to 40% accuracy penalty plus interest that the auditor would hit you with. So this is pretty exciting. And that rather than, and most people look at it and say, like $35 a month, that's like a little over $400 a year. It's cheaper to do that than to even amend the return. Why throw good money after bad, they say, when I can just change it at the very last minute when I have to. And you're waiting out for the statute of limitations to kick in to protect you on those old returns, as well as waiting, watching your new ones come through. So that's what a lot of people are doing. The big risk also I'm seeing right now is that the IRS has filed what are called John Doe summonses against Kraken and against Poloniex/Circle for records on crypto traders over with a certain characteristic.
Sure.
This is exactly what they did to Coinbase several years ago. I'm particularly bothered by this because rather than come out with guidelines for a let's call it a 1099 crypto form.
Mhm.
Rather than the IRS doing that, they're simply using the courts to go in and grab the data that they want because they don't know how to reduce it to a form. So, that bothers me at a fundamental level that this is
Sure.
kind of doing.
Overreach.
So Kraken and Poloniex have said, yeah, we'll do this. It really bugs me with Poloniex because Poloniex, I think in 2018, they closed. And everybody wanted their tax records from Poloniex. Nobody would give it to them. I have clients right now that are still emailing Poloniex. Poloniex won't give them their tax records, but Poloniex is rolling over and giving them all to the IRS. There's an injustice here. So if you do that, you want to keep that email for your tax records that the Poloniex wouldn't agree. They'll hit there.
Yeah.
So yeah, that bothers me. And they're going back to 2016, according to the records I've seen, so from Kraken. So what they typically are going to look for would be the standards for the 1099K, which would be someone who did over 200 trades or had over $20,000 in proceeds, not necessarily gains, but proceeds, which would be the sale. Like if you had $5,000 and you turned it over like 5 times, you're already at $20,000. So that'll get a lot of people, and they're going to discover, especially since right now, I mean, in terms of the 3-year statute of limitations, 2017 is kind of a closed book for most taxpayers. Its statute of limitations has already kicked in, but they're going to get data from Kraken, which might expose people who didn't report that Kraken income in 2017, and it's too late to amend that tax return. So that's a little disturbing to see the IRS taking that approach. So I think that's going to cause a lot of audits here in the future. But that's what we're prepared to defend against.
Nice. Yeah, I remember there's some recent news or whatever, they were talking about trying to lower maybe that standard to $10,000, I think was something that I'd heard the Biden administration had talked about recently. You heard much about that, or is that even something that's in play yet, or is that just something being talked about? Or
yeah, the Biden administration came out with that last week. Let's put that in perspective, right? Mm-hmm. So what I read is they're going to give that information to the IRS. Now, this flows from, as I mentioned, I got my degree in international financial regulations, specifically anti-money laundering regulations. And there is an international organization known as the Financial Action Task Force, or FATF, as we call it. It's a part of the IMF. And they have come up with recommendations on what anti-money laundering should be. And one of them involves reporting suspicious activity. And the standard is any activity over $10,000 would be considered, automatically has to be reported for banks and brokerages. And what we're seeing is an extension of this to the crypto industry, to the exchanges. Okay. Now, at the very end of the Trump administration, FinCEN had proposed, they're a part of FinCEN, the Financial Crime Enforcement Network, which is the anti-money laundering agency of the US, and they monitor it. They came out with a recommendation to say that any exchange transaction over $250 had to be reported. So when the Biden administration came in, they froze all that regulation. So now they're coming out with 10,000. So you could say that it's better than what was on the table. All right, but it's going to happen, and we shouldn't be surprised about this. This is the way it is. Now, there was I have some research papers which show that these reports are pretty much passive. Nobody's looking at them until they're actually looking for a problem. And I think I recall there was a government. I think the FinCEN was hacked on some of these things. And I think that's what happened. And then some other things came out that basically nobody's looking at these things. So there is an element of that. Once they suspect you of something, then they can go in and look to see if there are suspicious activities. And if there are, then it gets messy. And the bottom line is all of us are going to have these things reported on us. So it's not going to be a big issue. I mean, right. And the biggest thing you can do to reduce your exposure to this is especially if you're taking a large amount of money out of exchanges, like out of crypto, is to take a big chunk out all at once. Don't do it in small little bite sizes. Don't try to do it under $10,000, because that is even worse That's called structuring, and that is a telltale sign of someone engaging in a money laundering behavior or high risk behavior. It's far better to take $200,000 out. That generates one notice, and nobody's really surprised by that. But we start doing like 20, 999,000 once in a while. That gets people's attention real fast. So
sure.
My advice on that. Regulation is going to happen. Anti-money laundering regulation is going to happen. It's going to become more and more pervasive. KYC. It's just the way it's going to happen.
Sure. Well, so, I mean, now that we kind of understand a little bit more about the liability and kind of how they're tracking it and all of that stuff, maybe you could talk to us a little bit about some of the best places to maybe live, or be domiciled for your projects that would maybe shield you or give you some less liability than that. I know with U.S. citizens, wherever you go, you kind of are, still responsible to report. But, if you did choose to change citizenship or live somewhere else, what are some of the more favorable places for us crypto folks?
Well, great. Let's make that a little bit bigger. What are strategies if you're going to have a high income situation? What tax strategies can I take to reduce that impact? Yeah. Some of them are in the law, and we talked about the most important one, long-term capital gains. This is how the wealthy people leave their money in places for long-term, and they get long-term gains rates. It's about 40% less in many cases than the short-term gains. This is a great way to save on taxes. Second strategy is that you are free to live in any state. Each state may choose to tax your income based on whatever the IRS has calculated, but there's 9 states in the US where there is no income tax. You're in Texas, good for you, no income tax there, right?
Oh, none here.
You could be living in California where they're going to hit your crypto gains with another 13.8% tax, all right? And each state has a different amount. And, on one hand, I don't want to begrudge the states a certain amount of tax to fund the benefits that a state provides. But, I think we feel a little bit outraged when it's our work that did the work. Why do they get 13.8% of it, right? Now, if you're in California, you're not just paying more on income tax. They have a wealth tax called property tax, which is very high and it affects rental properties, and the sales tax is high. You're taxed all over, right? So you're making an expensive choice to live there. On the flip side, I want to say this. The states with some of the highest taxes are also where the wealthiest Americans are living. So taxes really shouldn't keep you from being a wealthy person, all right? But it would be smart. But if you don't have to live in California, if you don't have to live in New York, if you can live in Texas or Florida or Tennessee or, any of the 9 states, Google them, then you can make a big savings on your taxes. Now, a lot of people are interested. Now, for Americans have a unique situation that's not true about people from other countries. I know you have people from other countries listening. Americans are subject to what we call taxation on your worldwide income, regardless of where you live in the world. There is no place you can run and hide as an American to not be subject to U.S. taxation. Now, in other countries, if I leave that country and I set up residence somewhere else, I don't pay taxes back to my home country. That's the way most other countries are like, but not the U.S. On the other hand, we do have some nice tax breaks in the U.S., foreign tax credit, foreign earned income exclusion. But there's one loophole on this whole regime, and it's called U.S. territories. A territory in the U.S., like Virgin Islands, Puerto Rico, and American Samoa, and a handful of others, they are not states. They don't get to have a senator or a representative. And so, in America, we have a tradition that no taxation without representation. So these states, because they have no representation, have a different treatment on their taxes. They get to tax their own people on their own income. So Puerto Rico, for example, if you have income that is sourced from Puerto Rico, then under Section 933, you don't have to even report it on your U.S. tax return. It's not even written. So I said before, you have to report all your worldwide income wherever you live in the world, unless it's in Puerto Rico. In Puerto Rico, you don't have to tell the U.S. about it. Now, it doesn't mean you don't have to file a U.S. tax return on your other income, on your anti-money laundering forms and stuff, but you just don't have to report all that income. Puerto Rico has a special tax incentive program. You have to apply for it. It's typically called Act 22. They would know what you mean, where as an individual investor living there, that your gains from crypto investing have a 0% tax. So they're taxed at a 0% rate. Well, that's great news, all right? So having said that, let me just say that there's a lot of complicated residency rules in terms of living in Puerto Rico. The IRS is aggressively monitoring this because they know there's a lot of wealthy people there that might be skirting the laws, claiming that they're living in Puerto Rico when they're not really doing it. So there's a compliance campaign by the IRS there, an enforcement campaign. But in general, I would say if you already have realized $1 million in your investing and continuing to invest, then I would say you should be considering the Puerto Rican option. You have to put $10,000 a year into charities. There's a $5,000 a year annual government fee, and you're going to need a lawyer and tax advice, both in filing a Puerto Rican income tax return and U.S. tax returns. So you're talking about another $5,000 to $7,000 there. So you're into $25,000 just cost to make this thing happen each year. All right. So you want to have a lot of money already there. Plus, sure, after 2 years, you have to buy some real estate in Puerto Rico. The prices of real estate in Puerto Rico are outrageous. So for these things, that's why it's really not appropriate unless you already have $1 million, not if you think you're going to have $1 million. So here's how it works in Puerto Rico. Let's say I buy Bitcoin last spring at $6,000. Today, if I were to go to Puerto Rico today, Bitcoin is about $40,000. So I've already experienced a $34,000 gain while I was in the US, but I haven't sold it. I now go to Puerto Rico, and at the end of the year, I sell it for $70,000. Okay. So we consider that day I went into Puerto Rico, that's your bona fide Puerto Rican residency day. That's your mark-to-market date. The gain from $6,000 to $40,000 is reported on your US tax return, and it's taxed under US tax rules. It'd be a long-term gain probably. The gain from $40,000 to $100,000 is reported on your Puerto Rican return, taxed at 0%, so there's no tax. All right, and that's how it works. You don't have to pay that tax until you sell that coin. It could be this year, it could be a couple of years from now, but that we basically divide it and pay each party their amount.
I think that clears things up for sure. I know a lot of people have been asking about Puerto Rico. I mean, specifically like in 2017, 2018, I think is when I don't know if maybe they launched that Act 22 or something before then, but I remember that really kind of, a lot of people showing interest in that during that time period. So
yeah, I got about 50 clients in Puerto Rico.
Okay, cool. Well, now that we're talking about your clients, maybe I can just ask you one little small prying question here. So of some of your biggest clients, like, what do you feel like, what are their crypto kind of strategies right now that you're seeing, maybe that you can share, obviously without their name, but just like things that they're doing in the space that are maybe something other people could or would duplicate that you're seeing as being a good strategy?
A couple strategies. I mean, I talked to my largest clients. I ask them, what their thoughts are on that very question. Mm-hmm. And I remember one client saying, he said, just keep everything in Bitcoin and Ethereum. Mm-hmm. Said, you're not going to go too far wrong with those two. Anybody smart, and those are always going to go up. So he felt that was always a safe way to go. But he felt all the other coins from there. I mean, he loved to speculate. He loved to jump in and out, run the pump and dumps, and all those fun things. Yep. But his core assets were in Bitcoin and Ethereum. I also have another client who is, significant, 7-digit investor, and he's heavy into Ethereum, and he's staking the whole thing. He's going to live off the interest income from it. So that's another strategy that he's taking. So, my gut feeling on that one is that's kind of putting all your eggs in one basket. I mean, Ethereum has a lot of, contenders trying to take its title. Kind of difficult for me to envision locking something up for a couple of years, which could be, eternity in the crypto world. But really altcoins, most people get crushed in altcoins. I had another investor basically say, if you stay with the top 10 coins on CoinMarketCap, you'll be okay. Right. So I think we really need to, but there's the lure. I mean, but I had one client last year, I wish I was this stupid.
Right.
So he got his stimulus check for $2,000 and he invested it, I believe, in, who was it? McAfee's Hex coin. All right.
Okay.
He bought it dirt cheap. And of course, McAfee pumped it and it went up real high and he sold it and he had $100,000. And then he reinvested it. And then he got a couple more stimulus checks and he reinvested all those 100,000. And when he calls us at the end of the year, he's got $400,000. That's what I call stimulus.
Right. For sure.
Why can't I do this stuff? Yep. And then I had another client who, shoot myself.
Right.
So he got into crypto trading back in 2013 or 14. It was just, he was probably about 20 or high school, college, like that, and he lost a lot in 2013 and he just hung it up from then. He got married and his wife, and they went to Europe and they were, living in Europe, I think teaching English or something, simple like this. And he saw that Bitcoin hit $60,000 and he goes, oh yeah, I think I still have a USB stick with some Bitcoin on it. So he went and plugged it in there. And the next thing you know, old Jed's a millionaire.
Oh,
Kid from said, move away from there. He's sitting on $8 million. I couldn't believe it. He said, I'm moving back to Michigan, he said. So, there's all sorts of stories out there, but I guess that last story just basically says it's just a simple story of a stupid hodling. Mm-hmm. You could take every single one of your investors in the university today, just tell them all to hold. Right. And it might be that 8 years from now, you all be 8 million, all have $8 million. I mean, It's kind of a thing, and he actually, if you think about it, he was applying the very same strategy my whale investor was saying: stay with Bitcoin and Ethereum. Mm-hmm. These things are always going to go up. They'll be around. They're survivors. So, and that's my second story was about the guy staking Ethereum. He was staking one of the key coins. Mm-hmm. So we really, I think, so my biggest investors now, a lot of them are doing, I have some guys that are, I have one guy who's got a doctorate in mathematics and he's doing DeFi. I mean, tens of thousands of DeFi transactions because it's all derivatives for him. It's, his mind understands it. My mind can't really grasp it all, but for him, and he's making incredible amounts of money. All right. But that's him and that's his skill set. So, but, for everyone, but if you just stay with those first three stories, mm-hmm. stick with the basics and just wait for the money to come to you. I think you could do a lot worse than that.
Sure. Yeah. I mean, I know some of the other platforms that have kind of been popular lately are like Celsius and Nexo and some of these places where you can kind of, stake your coins there and get a return on your investment. Do you have any of the people of your clients using platforms like that, or do you have any feedback just on those platforms as a whole?
A lot of people are using them. You have to realize that when you're using those platforms, you're giving your coins to a company. Mm-hmm. And this company is not insured, and you're hoping it's going to still be around when you take your coins out. We haven't seen these companies collapse, but there is a trust factor here. You just have to realize that. So go ahead and put some money in Celsius. Go ahead and put some money in Nexo or BlockFi, but don't put it all there. At the very least, spread it around if you want to go that strategy. Don't put all your eggs in one company. Don't be destroyed. I think it's also attractive. There are online services like Aave, a Compound where I can lend, which are more smart contract driven. So I'm not really as exposed to company management issues, like say with Celsius. If you can trust the smart contract to work for you, I think that can pay very well. So I think that's a great way to make money. It's definitely, I believe that the banking industry can't wait to get into this game. They can't wait to corner the staking market, buy up all the staking nodes, and take this money to themselves. I think they're just itching for that.
Yep. Hopefully that will reflect well against all the spot value of those coins too. So hopefully
Definitely.
we're holding on to some good bags. Well, that's great, Clinton. Well, so I mean, I think our time here is probably getting pretty close, but I definitely would like to at least leave you a couple minutes here to talk a little bit more about your service, if you'd like to plug your website and anything else that you would like to just kind of leave our community with here, and then maybe we can tag you on a few posts in the future, maybe have you back on again or whatever if we get some more questions.
Well, that'd be great. I mean, I'm already thinking we're working on a presentation on the Biden tax plan, what that means to investors, crypto investors, and also other high tax strategies. And sadly, there's not enough people out there that can help, tax professionals that can help crypto investors in an intelligent way. And so we've created a service called cryptotaxaudit.com, and it's a monthly membership service. And there's 3 levels of membership. The middle one is the most popular, transcript membership, which, as I described before, we monitor for audits. And also, when you're there, we have a free course that we offer, how to do your own bulletproof crypto tax return. And by bulletproof crypto tax return, we're talking about it's the type of return you wish you'd prepared if you knew in advance you're going to get audited. And it's the type of return that our own company prepares for our large customers in Wales. We use it's the exact same methodology, exact same technique. So we show you how to do it with a piece of IRS free file software called Online Taxes, OLT, which is 100% free. So it's free software, free course to do your own taxes. And we're going to show you how to do a better tax return than TurboTax, Tax Act, and H&R Block, and probably 98% of all the accountants and CPAs you're going to deal with. It's use our methodology, which is proven to actually discourage audits from even happening in the first place. So super, super exciting to have people get that. We're going to be coming out with more courses like the Puerto Rican strategy and the Biden tax plan, some of these things. We're going to come out as courses that we're offering down there at affordable prices. We would love this to be a place where people can go, the crypto investors can go and feel like we understand what their problems are. We're giving them tools to defend themselves at affordable prices, and we're working towards having a community where people can ask questions and have a dialogue about taxes, maybe AMAs. And we're really, all our time and effort is going to be invested in there, because I can only handle maybe 500 to 1,000 crypto clients directly a year with my team preparing their tax returns and calculating their gains. So that's part of the challenge. Is really everything is down there, and I think everybody should sign up for the crypto tax audit membership. And it detects whether you're getting audited for crypto related or non-crypto related things. And as I mentioned, this bulletproof crypto tax return methodology, one of the things we do is we put a disclosure statement into your tax return. We actually show you how to do this with the OLT software. It's the only software product that does it in the free file group. And a disclosure statement, Form 8275, actually discourages an auditor from auditing your return. I had a former IRS auditor work for me for a while preparing returns. He always put these in. I said, why do you do it? He said, you got to understand, when this is in there, it deprives the auditor of your 40% penalty. So, he's not going to even initiate the audit, because every month auditors are ranked by how much money they brought in. And if you spend your time and you can't get the penalty, you're going to hit the bottom of the ranking. So he said, we just put those aside. We never start the audits. And we've done this for about 800 returns. And I have one return, which we knew we'd get audited. We were asking for a $400,000 refund on 2017 and on his crypto reporting. So we changed how it was done. And we knew he got flagged for an audit because our service discovered this July of last year, 2020. It was flagged for an audit. As of now, we're here at the end of May. I mean, this thing will probably be televised in June. We're into 11 months. We'll be at 11 months, and the audit has not begun. Remember I said it was an average of 6 months? Here It's 11 months. If the auditor waits like 4 more months, the whole thing, the statute of limitations kicks in, and he won't have to even initiate the audit because there's no upside to him. So this is a real story. This is it's one of my few clients. I'm excited to see if he gets audited or not. I mean, that's probably bad, but I'm really excited about this case because it proves the point that we've been talking about, that this works. And we teach people how to do that in this course when you're a member of Crypto Tax Audit. So hey, I can't handle everyone's questions. We don't have enough time or space to answer. Everybody has a unique situation, and I respect that. And we have a limited amount of staff. So we're just trying to put maximum value to help as many people. And we want to have thousands and thousands of people being benefited by this, including everybody at Crypto U that are US citizens.
Yeah, well, thank you so much for your time, Clinton. I really do appreciate it. It's definitely been a valuable conversation and one that I've learned a lot in, and I'm sure everybody else in our group will learn a lot in too. So I will make sure that we link your website there and make sure we send everybody your way, because you definitely know what you're talking about it, and we greatly appreciate that information. So thank you once again, Clinton. I appreciate it.
Thank you so much for the opportunity.
All right. Thank you, Crypto U. We'll bring you the next one. After whoever it is that you want to see us do an interview with next, just put some comments below and we'll make sure that we get them on next. So thanks again, Clinton. Have a good day.